Good afternoon. Market news now. Chinese markets rose, tracking gains in other Asian markets. The U.S. markets also rallied overnight as comments from the Fed chair appeared to reassure investors. Hong Kong's Hang Seng Index led gains in the region as it jumped 2.7%. Mainland Chinese markets also rose and Japan's Nikkei jumped 1.9%. Economic numbers out in Asia included China's Consumer and Producer Price Index for December. China's CPI was up 1.5% compared to a year ago. Factory prices climbed 10.3% from a year earlier, slowing from the 12.9% rise in November, opening the room for policymakers to loosen monetary policy. European stocks were muted as investors await the latest reading of U.S. inflation data. It is expected to show that inflation at the consumer level spiked in December, the hottest jump in prices since the early 1980s. Economists expect the consumer price index to come in at 7% on a year-on-year basis. But to talk to us about how all of that is affecting our local markets and why you should be interested in some of the aspects and themes flowing into 2022, we are joined by Chantal Marks from F&B Wealth and Investment. Chantal, thank you so much for your time. I mean, we've, taken in what the Fed chair had to say at his Senate confirmation hearing, but how has our local markets reacted to all of that news following last night?
Well, our local market has reacted very positively, but I do think that it's mostly a function of what we've seen on the Asian side of things this morning. A really strong rebound in Chinese technology companies really aiding Naspers and Prosus today, and that really pushing the market higher. And then also, I think some general optimism around the Chinese story and the growth outlook in general, particularly after that testimony from Jerome Powell. Perhaps leading to commodity prices pushing higher slightly, the oil price pushing higher, and as a result, we also saw our resources complex up quite nicely today.
So from a currency point of view, I mean, if you look at the performance of the dollar last year, it pretty much dominated. But following, some of the comments this time around, the dollar seemed to be loosening its grips, especially from an FX point of view, weakening against some of the G10 currencies except the yen. How has the dollar and the rand in particular reacted to the Fed chair's comments?
So I think towards the end of last year, there was a lot of fear that the Fed was going to be complacent when it comes to inflation, that inflation will spiral out of control and that rate hikes will have to be a lot larger than what was initially anticipated. It does seem, though, that every time the Fed chair speaks, the market kind of settles a little bit. And I do think that their commitment to maintaining inflation into a longer term accommodative at a longer term accommodative level is still there, which means that you will see interest rates increase, but they're not going to jump the gun. They're not going to shoot from the hip because they still believe that the long-term structural story for inflation is that it will remain quite benign relative to historic standards. There are many reasons why inflation is very high at the moment, and it could be high for quite some time. But longer term, you would still see it kind of level off. I think as a result, you saw the dollar weaken a little bit, and you've also seen currencies globally strengthening, the rand also being one of them, and actually breaking through a key support level today of 15 Rand 50, currently trading at around 15.48.
So talking to some of the market watchers over the past couple of days, I mean, I've been trying to find out from them what they think will be some of the risks going into 2022. None of them seem to have brought in China. It's all around whether, a new variant could pop up at some point during the year or even the inflation story. And I'm curious to know, what are your convictions when it comes to China?
So I think that the Chinese story will be very dependent on how they proceed in handling COVID-19. So far, they've taken a very hardline approach. So whenever there's a flare up, they'd lock down an entire city. They're right in the middle of that again. And if we look at the latest variant, the Omicron variant, and how it has behaved relative to previous variants in terms of how sick it's made people, hospitalizations, deaths, all the rest, it really does seem seem as if we're getting to a more endemic stage of the pandemic. And if China starts relaxing its hardline approach, there's no reason why that country couldn't grow quite quickly following what has been 2 years of very severe disruption. So I'm quite positive because the science will probably back it up. But again, I mean, you don't know with this thing. We just saw Anthony Fauci speaking earlier in the program saying that it's taken them by surprise, and a very aggressive or terrible variant that has dire consequences could be on the horizon. And then China would be right to continue to lock down cities.
Right. So let's bring it locally a little bit and talk about some of the opportunities you may be seeing on the JSE despite the low economic environment that we're in from a growth perspective.
So I think there's still a lot of value in the small and mid-cap space. I mean, we did see that space do quite well last year, and we've seen a lot of interest in terms of takeouts and buyouts and mergers and acquisitions in that specific space. And I think that theme will probably continue into this year. I'm particularly interested in looking at these investment holding companies, particularly the smaller ones, Long for Life, RMH, African Rainbow Capital. A lot of them still trading at reasonably deep discounts, but a lot of interested parties looking at perhaps acquiring some of these assets, or even these companies themselves winding up or making new acquisitions. So a lot of action expected in that space. And then the behemoths, Naspers and Prosus. I think if we do see a continued recovery in Chinese internet and China's prospects, those two stocks could do very well for investors this year.
Right. We've got about a couple of minutes left. And, you know, following what happened about a week ago when we had the Fed minutes from December come out, we saw, you know, tech shares not really, performing the way one would have expected. They had a bit of a disappointing week. Does it question from your perspective whether the tech rally is over? I mean, how are you looking at tech? Is that outperformance that we've always been expecting, I suppose, coming to a close in the short to medium term?
So the tech question is very interesting because I actually looked at a piece of research a week or so ago where they mentioned that interest rates and tech shares have like an 85% correlation. So when interest rates in the US go down, tech shares tend to go up. But I think correlation and causation are two completely different things. Tech shares in their fundamentally should do well because they're disruptors. They are disrupting the status quo. They are selling something that people want and people need, and they are taking part in secular themes. So things that will change the world going forward. While there will be some sort of a derating when you do get interest rate increases, longer term, I think that the fundamentals of these companies and the thematics surrounding these companies shouldn't be perturbed by higher interest rates in the US. So if you do see these companies coming under a lot of pressure, perhaps it's a buying opportunity more than anything else.
All right, Chantal, thank you so much for your time. That is Chantal Marx from FNB Wealth and Investment. Of course, the key information that everyone's going to be looking out for, and we'll analyze that for you tomorrow, that will be the US CPI numbers that are due in the next couple of hours. That is it from me.